Hi, I'm Linda Eedes, and this is an update on the RECM Equity Fund, focusing particularly on the third quarter of this year. So the equity fund was up over the last quarter. It returned 2.7% after fees, but that looks quite unimpressive if you compare that to the all share, which was actually up almost 9% just for the 3 months. I think what's important though is that one has to take a step back and look at that index return and say, well, what generated that? The all share index over the year to date has generated 12.5%. Now NASPAS, which makes up 18% of that index, was up 46% over the year to date. Continues to defy gravity. Great business, but 46% up from already quite high levels at the start of the year. Now that makes up almost 2/3 of that 12.5% return for the all share index. Now if one adds Richemont, which is also another global business which is listed in South Africa, that makes up 6% of the index, and that was actually up 36% of the year to date. So if you actually take those two stocks alone, they explain 80% of the all shares return over the year to date. So what you're getting is a very, very sort of narrow reflection of how South African equities have performed. In actual fact, the vast majority of equities have not performed very well at all, as you might expect from what's going on the domestic front. The good news for the RECM equity investors are that we do have Richemont in the portfolio. You might remember that that stock actually came under quite a bit of pressure when luxury goods sort of dropped off quite significantly, particularly given sort of a perceived slump or slump in Chinese demand. And we've actually benefited by having that in the portfolio, and as a result of that stock doing so well, we actually had to bring that position down somewhat. But also the resource stocks continue to do well. Most industrial metal prices were actually up over the last quarter. We have a smaller allocation to resources, as you'd expect, having performed so well over sort of the last year and a half. And those stocks did continue to sort of contribute to returns over the quarter. And then lastly, MTN, which is one of our top 10 stocks, actually had a little bit of a sort of sign of life over the quarter. It was up 10%, and that I think was really a sort of a reflection of the fact that they have now got the Nigerian fine, which caused losses, out of the way, and they'll be returning back to profit-making territory, which I think investors are quite pleased about, including us. So those three sort of areas of the portfolio did very well. But we do have quite a strong kind of allocation towards more domestic South Africa incorporated type businesses, many of those industrial businesses, and those businesses have been through a tough time. So we think they're positioned very well going forward, but their prices don't reflect that yet. So the prices are still reflecting the current mood, which is that they've obviously gone through a tough time. They're in many cases still going through a tough time. But if you actually sort of take a little bit of a longer term investment horizon, you know, now's the time to actually be picking up many of these businesses which have actually almost in a way been bolstered by the tough time they've been through. They've actually had a hard look at their businesses, they've recapitalized, they've restructured, they've focused again on their core businesses, sold off non-core assets and the likes. And a lot of those are sort of turnaround stories coming through, or businesses which are just kind of seeing through that cycle and which will benefit as that plays out. So if you look at the portfolio as a whole, we've introduced a few new stocks. I think the most significant of those is our introduction of FirstRand as exposure in the portfolio. That is our preferred banking exposure, and that's really sort of predicated on the fact that the banking industry is going through quite a tough time itself. If you look at sort of credit demand, which is the lifeblood of the banking industry, that remains muted. If you look at sort of the business cycle, just in general for banks, it's kind of, you know, close to where it was actually in the financial crisis. So one does definitely, as a value investor, want some exposure to that part of the market. FirstRand, you know, given their track record of returns on equity, if you actually look at the current price to book ratio and what that's sort of pricing in, those two components together, it's pricing in sort of 10 to 12% growth from this point. We think that's reasonable for that business, and you know, especially if you look at where we are in the cycle, it's quite a low point in the cycle as well. So we prefer to take our exposure to the banking industry through FirstRand, which is of course a very high quality business itself. So looking at the overall portfolio, I think what's great is that it is a more diversified portfolio than it was 2 years ago, when you sort of had quite a high sort of concentration of resource businesses in the portfolio, and that obviously had some implication for the volatility of the portfolio at the overall level. We really have done our utmost to diversify the portfolio more. We've done a lot to actually sort of increase the quality of the overall portfolio, the types of businesses we hold, sort of really setting a higher bar in terms of sort of the underlying businesses themselves. And we think that this portfolio is set to do incredibly well from this point onwards. I think a lot of sort of more benchmark-oriented managers are probably managing expectations of returns downwards, and we're sort of saying this is the time to actually have an allocation to a value manager. It is the value managers such as RECM which are going to be delivering the returns over the next market horizon.